Well, hello everyone, and welcome to Risk. I'm Lee, and today we have a very special guest, Mr. Michael Pento, returning to the channel. Michael, how you been? I know it's been a little crazy down there in Florida and continues to be.
Yeah, thank God we're all okay, and pleasure to be on with you again, Lee.
So we certainly have a lot to dive into here. I mean, the world economy seems like a mess. We have this very sharp bounce off the lows in the equity markets, and then kind of a sell-off in the dollar, which I think was a little bit overextended. How do you see things now?
Well, I mean, bear market bounces are violent, and they scare everybody into thinking that the end of the world isn't coming. But guess what? In financial terms, the end of the world is coming. It's going to be near perdition for stocks. They're still trading extremely expensive, 18 times 2023 earnings. That's ridiculous because, first of all, that's a very rich valuation, but the P is rich, the price is rich, and the earnings, the denominator, is fictitious. Earnings are not going to grow by 5 or 8% next year. Earnings are going to shrink. Earnings during recessions usually shrink about 30%. That's not a mild recession. We're going to have a very, very steep recession. The recession really began, Lee, by the way, in 2019. If everybody would just remember, harken back to the end of 2019, guess what was happening in 2019? The repo market froze and the Fed had to cut interest rates from 2.5% all the way down to 1.75%. Why? Because whatever was happening in the economy, the debt levels, asset prices could not sustain the thought at that time that Powell threatened to be hiking interest rates to 3.25% to 3.5%. Well, they're 3% right now. And we're going to be way above where interest rates at 2.5% caused the economy to fall apart and the repo market to freeze in late 2019. So, by the way, since that happened, since that occurrence of late 2019, we've piled on an incredible amount, a massive amount of leverage and debt in the system. So it's going to be a very steep recession. By the way, also, let me add one more thing before I let you back in. QT was not occurring in 2019. It had ended already. So whatever's happening to the economy is going to be brutal, and it certainly doesn't support stocks at 18 times a fictitious earning.
I look around, I see no bullish case on the fundamentals. I mean, the whole supply chain is collapsing. We're having all these energy issues, and we've had inflation. What's your take on the impact these things are going to have? Obviously, you're expecting something pretty dark.
Well, I mean, supply chain may be healing on the margin. I expect that to happen, but the crux of the matter is that 83 or 85% of the world's central bankers are hiking interest rates. That has never happened before concurrently, in congruence, all hiking aggressively into a global recession. You know, the first 2 quarters of 2022 were negative. We might have a small bounce in Q3 because of an inventory build, but we're going to go right back into negative growth, seasonally adjusted annual rates in Q4. And the Fed is hiking, not just hiking into that, they're aggressively hiking to that. So who cares, Lee, if they go from 75 basis point rate hikes down to 50? That's the hope on Wall Street. That's the new version of a Powell pivot. It's not going to be, the Federal Reserve or Jerome Powell at this juncture is going to now start slashing rates back to zero as fast as possible. That's not happening, Lee. He's going to go from 75 to 50, probably do 50 or even 75 in November, and then another 25 or another 50 in December. And either way, by the end of this year, the Fed funds rate will be close to 4%. And I'd like to remind you and your audience that whenever the Fed starts to cut rates, it's the worst time to go leverage long stocks. I mean, the Fed started cutting rates in 2001. Was that a very good time to start piling into the stock market? No, S&P didn't bottom to the end of 2022, and just barely. And then in 2023, we started going to a bull market. So, and in 2007, the summer of 2007, August of 2007, Ben Bernanke started to cut interest rates. That was not your cue to pile into equities. So just be careful. Just because the Fed is pivoting from 75 beeps hikes to 50, maybe, that is not a reason to celebrate. And you shouldn't also celebrate the fact that 1.1 million people are no longer the job openings dropped by 1.1 million openings have been wiped out. So that's less opportunities for people to get jobs. The economy is weakening, earnings are weakening, and we still have $95 billion in QT per month and massive rate hikes. That is not time to get bullish.
Well, what do you think of the bond market in this environment with what's the Fed's doing? I mean, are bonds toxic at this point?
Yeah, I mean, they've been toxic. I've been a bull on duration bonds for the last few months, and wrong. Early is wrong. I've been wrong. Very, very open about that. I've been right about everything else pretty much. The dollar's been a spectacular trade for us. Our shorts are working out very well. Being wrong on the bond market, being early on the bond market is what we are. But I have never seen a recession in my lifetime, or in fact, in the history since the Buttonwood Agreement was signed. I have never seen a recession, especially a global one, that was marked by rising interest rates. Now, this time may be different. I could see many reasons why it would be. But the bond market did collapse. The 10-year Treasury note was 0.33% at the nadir, 2022. It's now closer to 4%. And I could see a lot of buying interest into sovereign U.S. Treasuries. Just because, where else in the world are you going to get yield from? Are you going to get it from Japan? Japan has, their JGBs are capped. The buffoonery there is off the charts, 0.25%. And they're burning, printing money like mad, trying to cap that rate and threaten to burn through their currency reserves to try to keep it there. So that's one of the risks to Treasury. So that's where the reserves are. But I do think the private market will come in and in a surge for safety, relative safety and yield for a time, will try to sequester funds into Treasury. So that's what I'm thinking. But it's only a 6% position in our portfolio. It's not like we bet the farm on it. What I really would bet a lot of money on is short duration Treasuries, because the Fed is going to be able to get to 4%, I think, but that's already priced into short-term Treasuries. So a great place to hide out the storm right now is short-term Treasuries, because you're going to get a fat, juicy yield, higher even than the 30-year because of that inverted yield curve, higher than the 10-year because of the inverted yield curve. And when the Fed has to start to capitulate, and they will capitulate, but slowly, you're going to get some principal appreciation.
Well, what about blue chip corporate bonds?
But horrible. I mean, corporate bonds are a horrible investment. Dividends are a horrible investment. They're lower than Treasury notes. I mean, why would you ever buy a corporate equity with the hopes of getting a dividend that's less than Treasuries and all of the risk that's concomitant with owning equities? It just doesn't make any sense at all. And if you look at high yield corporate debt, yes, they offer a better place to hide than junk bonds, but all corporate debt gets wiped out in a recession. So as far as the price is concerned, so it's not my first place to go to, and it wouldn't even be my second place.
What's your view on the commodity space right now between precious metals and oil and natural gas, etc.?
So I built the model called the inflation, deflation, and economic cycle model. I rigorously back tested all of the components: currencies, commodities, equities, everything. And the last thing you want to own in sector one, which is disinflation, deflation, recession, depression, is commodities of all kinds. Now, I know that, the corn has a little bit of a bid, oil did collapse from way above $100 down to $85 a barrel WTI. But listen, that's probably the best place to hide. If you have to own commodities, I would have money in corn and especially energy if you have to be there. But why do you have to be there? The demand destruction, which is still to come. It's we're in probably the third inning of demand destruction. There's so many people out there who are still talking about earnings growth, And if we have a recession, it'll be a short, shallow, brief one. That's just not at all what I'm seeing from the collapse in the automobile market, the real estate market. These are just incipient collapses that have yet to really intensify and metastasize. Inflation is peak. I think it has peaked and will come down. But for two reasons are going to keep the Fed, three reasons why the Fed has to stay very vigilant as far as inflation is concerned. So they're gonna start to reduce the Fed funds rate probably later in 2023, but it's going to be because the credit markets freeze. In other words, you can't float commercial paper, junk bond market freezes. It's going to be because of a collapse in a pension fund, hedge fund, perhaps an investment bank goes under. That'll cause Powell to pivot, a real genuine pivot. But don't forget that what has happened to the Federal Reserve is they've lost all credibility. Now, they've lost all credibility with me since 1913. So they never had any credibility with me whatsoever. But they still had credibility with most of Wall Street, what I call the deep state of Wall Street. They had a lot of confidence in them, but when they said inflation was transitory, and by transitory that meant record high inflation. It was 40-year high inflation, the way they measure it, but in reality it was 20% annual inflation, year-over-year inflation.
Yeah.
So many metrics and housing and commodities. So they have massive egg all over their faces, layers and layers of egg. So they have to restore that. But two other reasons why they have to be reticent about lowering interest rates is because if you pull up a chart from the Labor Department, there just isn't a lot of people to lay off. So the non-farm payroll report is going to start looking bad, but it's not going to be as bad as it was in 2008 when you see people, hundreds of thousands of people getting laid off. Or in 2022, in the spring of 20, massive amount of people being laid off because they weren't ever hired. Because if you look back to the spring of 2020 to today, there's less people in the labor force now than there was back then.
There's no fat there to trim.
You just can't fire what you didn't hire.
Right. Yeah.
So that's number one. And inflation is going to be a lot stickier because 40% of core CPI is owner's equivalent rent, and you still see rents rising in most of the country. So you're going to see that particular metric drop much more slowly than say, gasoline or food at home. That's going to drop much more slowly. So you have higher inflation for longer. It's going to be disinflation, second derivative, disinflation, but still very high. You're not going to see a collapse in the labor market. And the Federal Reserve will do everything they can. Now, they just got on record after being completely wrong about transitory inflation, the way they define transitory. I always thought inflation would be transitory. I didn't think we were going to have hyperinflation going out years and years. I said in the next year or so, it's going to come back down slowly, but come back down. I was correct. The Fed said transitory inflation it's going to go to 2% in sometime in 2022. But instead it went to 40-year high. So they were wrong on inflation. Now they've all come out and said that we're going to go to 4% by the end of this year. Imagine if they backtrack on that. What credibility could they possibly have? How could you believe them on anything?
And these people have a tremendous influence on our economy. It's actually quite frightening when you think about it.
Lee, it's I don't know, the adjective you use is frightening. I think it's disgusting.
Yeah.
I think it's disgusting that an organization founded in 1913, which is supposed to be the lender of last resort. In other words, operating in the background, you as a financial institution, a member of the primary dealers, had an institution that had solvency concerns, would take your distressed assets and you could sell them to the Federal Reserve at a discount, and you would get cash at a penalty rate. Okay. It was never supposed to be the institution that was what everyone had to be myopically focused on. interpret them like we're interpreting scripture from the Bible. What did Powell mean by that?
I always picture the chairman of the Fed walking out on like a balcony with horns blowing like he's the king making his declaration.
And they put themselves there. We allowed an unelected, unaccountable entity to rule the world. Entities, Bank of England, BOJ, PBOC, BOE, they rule the world.
Yeah.
ECB, sorry, I said the BOE twice. These people rule the world. Everyone is so concerned about everything they say because they control the supply of money and the cost of it completely. There's nothing else that matters except for what are you doing with your balance sheet, Mr. Powell? How fast are you burning money? How fast are you adding to the money supply? How fast are you burning it? And what's the cost of money going to be? Because that is going to be dependent on where asset prices go. And asset prices now, which were at the apex, 210% of GDP back in the start of this year. Asset prices are the economy. In other words, if the wealth effect isn't in place, if you're not constantly infusing money supply and asset price growth into the economy collapses. Because
it's even more nefarious than that, Michael, because they have assets that they buy off balance sheet and no one knows what they are. So I mean, the manipulation that they can do in the markets is just mind-boggling.
Well, it's the manipulation that they're doing in the open that I'm most concerned about. I mean, they were buying mortgage-backed securities. Everybody knows this. They were buying mortgage-backed securities until June of 2022. I mean, what in God's name were they doing trying to inflate home prices in the middle of 2022, when home prices were up 20% per annum year after year, and people are priced out of the real estate market? Think about how dangerous these people have become, and how unaccountable, nefarious, feckless. And yet we still worship these people and give them all this power. I don't know. I don't get it. But hopefully on the other end of this, I say hopefully, but I don't have that much hope. We'll go back to a monetary system that's based on specie. The mine supply of gold, which is 1 or 2% per annum, which is equivalent to potential GDP growth, keeps the money supply in check. And then the price of that money is based on supply of savings versus demand for money. And we'll have a normal economy without this boom bust asset bubble, wiping out the middle class, a trenchant gap between the wealthy and the poor. That's what we need in this world. Yeah. When is it going to happen? When are we going to realize the error of our ways by giving these people the keys to the world?
I don't think your average person gets this, Michael, and I think that's the biggest problem. Just people just tune it out when they hear anything about economics. They feel like they're not competent enough to understand what the hell is going on. And I think the Fed's partly responsible for that because of all the fancy terminology they use.
Yeah. Oh, yeah, the NARU and R-star, and people hear about the balance sheet, think of, they're worried about Kim Kardashian paying a fine. I mean, we need an education. We need the educational system to step up here too. What are they actually doing? What is the theory of money and credit? I mean, why is money, a green piece of paper, have value to it? What are the limitations on its supply? Why don't we use barter anymore? Why are we off a gold standard? All these things have to be taught to people, and they have to care. And I don't think Lee, I don't think they will care until we have, hyperinflation and depression.
Yeah, until it gets so bad that they can't take it, it'll continue. I agree. Yeah.
Where are you getting any? You're in the vanguard. People like you in the vanguard, opening people's eyes. But most people don't. They're not being told when they tune on, ABC News or watch Jimmy Kimmel Live. What information are they getting, economically speaking, about why, what the problem is and how we got there?
Well, I remember years ago when I would put on CNBC and the like, and they would say like the market sold off on profit taking. What the hell is that? It doesn't mean anything. It's just nonsense. And that's what they see on the major networks.
Well, CNBC, CNBC and all the where do they get their revenue from? They get their revenue from, the deep state of Wall Street. So, and the deep state of Wall Street has to be, long. They if they raise more than 10% cash, they get a call from the compliance department. You can't be charging money on 10% cash. So you have to go, you have to go all in. They can't short stocks really, so they have to promote this perpetual bullish view, and places like, the mainstream financial media give them that platform with alacrity.
Absolutely. I just want to circle back because you mentioned real estate, or you dabbled in it a little bit in this discussion, and I'd like to get your current view on both habitational and commercial real estate and investing in those sectors. I mean, do you think they're toxic assets at this point?
Toxic, absolutely toxic assets, because even though the underwriting standards have improved, I do concur with that. What we have that we don't have in 2008, two things. We have institutions and investors that own 25% of real estate. And almost a third of all homes purchased in the last year were purchased by institutions and investors. When you own 5 homes and the price is going higher, you're a genius because you rent them all out. You're getting, the rents are going higher, and your balance sheet looks terrific because the prices are going through the roof. Wonderful. You put 20% down, happy for you. But when the renter can't pay rent because they don't have a job, and or the home price starts falling in value, you start dumping those houses onto the market. So that's problem number one. That's happening. I think there's going to be, I don't want to hear about this, demographic BS. Okay, that's long duration stuff that doesn't matter, short cycles. What we have now is an overabundance of ownership of multiple homes, either through Blackstone or through your neighbor next door or you, who have rented them out and think you're some kind of real estate, some kind of Donald Trump part 2 real estate guru. Okay, you're not. And when the home price starts to fall, you'll dump it. But the other problem is that the home price appreciation was much greater than it was in 2000, leading up to 2008, the Great Recession. So you have the home price to income ratio at a very big higher high than it was in 2008. So you have a lot of downside in both commercial because of the collapse in the job market I see coming, and the private sector.
Is there anything else out there that you think people need to know about or be aware of?
The automobile market doesn't look too very good either. The loan to value there is negative. Looks like subprime part 2 to me. In fact, Danielle DiMartino Booth and Lacey Hunt had a lot to say about this on a recent interview. So you can check that out. Also, I'm sure you have a lot of people say the same thing about the automobile market. Hey, listen, when the government says here's thousands upon thousands of dollars free to you, go out and buy a car, and by the way, you don't have to make any payments on that car. Don't have to make any payments on student loans, and you have rent and mortgage forbearance. All that is coming to an end now. Now the grand reconciliation of asset prices is upon us. And I sure as heck wouldn't get, over my skis out of every single bear market bounce. This is a bear market bounce. We've had it the last 2 days. It might last a week. It might last 3 weeks. It might end by the end of the day today. I don't know. But bear markets should be sold until we have a re-liquification, not just a pivot from the Fed, a re-liquification of the financial system. And it's the opposite direction right now. Financial conditions are tightening, and they're tightening rapidly.
It's very much a trader's market and not an investor's market out there.
Well, if you want to be a trader, you could try it. It's very difficult. That's correct. But if you want to be safe, the safest thing to do is just take your money and move it into cash, move it into short-term treasuries. If you're smart enough to do that in January of this year, you're an absolute genius. The other thing you could do is try to make money from this grand reconciliation of asset prices. So you should be in cash, short the market, and short and long duration treasuries. Because like I said, once the recession becomes fully manifest, those treasuries will catch a bid. You can in the past made a tremendous amount of money being long treasuries only. So it's the US dollar, treasuries, shorts, and cash. And then the best thing about that is you'll have most or of all your money, or even more than you started with, to pick up the pieces when this grand reconciliation of asset prices fully consummates, which I think it'll be sometime in 2023. It's not October 2020.
Yeah, no, I agree with you. Michael, why don't you tell the audience about how they can get in touch with you and hire you for your services as an.
Well, if you're a U.S. citizen and have $100,000 to invest, you can go to my website, pentoport.com. You can email me directly at mpento@pentoport.com. And the phone number for the office is 732-772-9500. We have office in Naples and Florida and in New Jersey. On the website, you'll see a midweek reality check, which is $50 a year. And there's a 5-week free trial. So you get my thoughts from the 36,000-foot view of where we're headed. So I encourage everybody to do that.
Michael, thank you so much for your time. It's been a fascinating discussion as always.
Thank you, Lee.